we have these questions over here. Okay, base set group. 40 marks plus 10 marks for the professional skills. So the group is a publisher of newspapers and magazines. Okay, academic journals and books. The group, a listed entity, has a financial year ending 30th April 2018, and your firm was appointed as group auditors in September 2017, which is your first year audit for the client. This is a new client. Okay, this is a new client, and the audit firm will audit all group companies, with the exception of Bozoi's Core, a foreign subsidiary, which is audited by a local firm, Saluki Associates. The group aims to comply fully with relevant corporate governance requirement. You are the manager responsible for the group audit. The following exhibit provides information relevant to the question. Partner's email from Carrie. Yeah. Background information, audit team member, meeting notes. Okay, so that is exhibit 1 here, the partner's email. So to audit manager from the engagement partner, and the question requirements are actually here. Yeah, hello, I have provided some information for you to plan for the audit. One of the audit team members have already performed limited analytical procedures based on the group's projected financial statements and comparative, and I have provided you with the result of this work. I have also provided you with an extract from the communication which we received from Gray & Co., the group's previous auditor. Okay. Using the information provided, I request you to prepare briefing notes for our audit team planning meeting. So evaluate the audit risks to be considered and identify and explain the matters which audit team should approach with high degree of professional skepticism. So what are the matters that you need to approach with high degree of professional skepticism? Professional skepticism means the attitude of the auditor, where auditors are always stay alert with the indication of misstatement. You always ask question, yeah? Is the attitude, okay? So we will look into the matters and then we tell the examiners, yeah, what matters and why we will use high degree of professional skepticism for that. Part B, to assist the auditor, audit assistant's understanding of the audit strategy. Okay, explain the term significant component and assess whether Bozoi is a significant component, and discuss the nature and extent of involvement which our firm should have with the audit risk assessment to be performed by Saluki Associates. So the 2 parts over here is about group audit, 8 marks requirement. Then you write the principal audit procedures for the segmental information relating to group's revenue. So after you have read the exhibit 1, okay, the things that we can start writing is the format for the briefing notes. Yeah, you can start writing for the briefing notes format, because that will be score the professional marks. So we only write 1 time, yeah, for the briefing notes format throughout our revisions. Subsequently, I will just put briefing notes format. Okay, so briefing notes always start with the title, and we can mention to audit engagement partner. Okay, correct. And then this is from the audit manager, and subject is what is this company again? Assets Group. Okay. Okay, it's about audit planning. So use the introduction paragraph so you can refer to the notes, yeah, what I have been provided to you. The briefing notes, yeah, these briefing notes are prepared to assist with the planning, the audit of assets group for the financial year ending 30th April 2018. Okay, the notes contain an evaluation of the audit risk, because the first part of the question is asking for audit risk. So basically we will be telling what is the content of these briefing notes, which is the question's requirement. Yeah, but audit risk a bit more to tell for the introduction paragraph, that you need to base on the likelihood of the misstatement and magnitude of the misstatement. So we mentioned here audit risk which should be considered in planning the group audit, which has been structured to prioritize. Okay, the way you arrange the risk from the highest risk to lower risk based on the spectrum of inherent risk, you already can score the analysis and evaluation professional marks. So knowing how to arrange the risk is also one of the professional skills. And because of using computerized system for the exam, this part is not that difficult. Yeah, you can type whatever of your answers, then only you rearrange the answers. Yeah, that is fine as well. Okay, structure to prioritize the risk in terms of the likelihood and magnitude of misstatements. In relation to each risk. The notes also consider what matters will require auditor, auditor to what? To maintain approach with a high degree of professional skepticism. Yeah, to approach with a high degree of professional skepticism. Also, the notes will recommend audit procedures to be performed. The question talking about segmental information. Yeah, perform on the segmental information. Okay, so these are the requirements of the questions, and you can start with the subheadings to answer the questions. Okay, use of short paragraph. So here is part A, 1 and 2. Okay, A1 and A2 we can answer them together. It's about audit risk and also the methods why auditor will assess it with the professional skepticism. So we will need to look at the questions to start a range for the audit risk that we have identified. So first of all is the detection risk, because this is a new client to the audit firm, right? It's a new client. So we have the detection risk. So find somewhere in the exam platform and then you type the answer here. Okay, the first one is a new client. Then later you rearrange which one is more important. Yeah, so far we have one only. Exhibit 2. Okay, background information and results of analytical procedures. Background information and results. The group operates globally, with sales being made in over 100 countries. The group has 20 subsidiaries which have been acquired over the last 30 years. All group companies are located in the same country, with the exceptions of Borzoi Co., a foreign subsidiary whose operations focus on the translation of published content into a variety of different languages. The group publishing activities can be categorized into 3 operating segments, each of which are cash generating units for the purpose for impairment reviews: newspaper and magazines, academic journals, and books. The revenue and total assets for year 2018 and year 2017 are provided as follow. Okay. So newspaper, academic books, journal, the books. Alright. Look at the total revenue. The group total revenue has dropped by 5 million, but the asset has increased by 10 million, which is 11.8%. Okay. So during the financial year, the group has invested in software with enhances and extends the group's range of digital publications across all operating segments. Now, one thing about the exam structure is when you read something from the scenario which you found that it is quite different story with the previous paragraph that you have come across, probably the previous paragraph would have some audit risk that you need to take note. So like just now we have run through operating segment, we run through about impairment reviews. Okay, then after this, the next paragraph is talking about digital publication. That means something you can write for these 2 points. Okay, so I will also arrange it over here. The audit risk, what we have is the operating segment. Okay, operating segment is a requirement for the disclosures for listed entities, and this company is a listed entity. So operating segment have to fully disclose it. Yeah, that is part of the audit risk. And they mention about impairment. Okay, impairment. So are there any impairment? Now, for impairment, right? For impairment, look at the newspapers and magazines. The revenue has dropped. Academic journals revenue increased by just 1 million. Yeah, compared to the others, the increase it seems not a lot. Yeah, and books also drop. Having drop in revenue is an indication that some of these operating segments should be assessed for impairment review, because their carrying amount could have been overstated if they don't do so, right? So we have impairment points to discuss. Okay. Then they mention something about digital publications across all operating segments. The total investment, which is recognized as an intangible asset, was 50 million, of which 5 million relates to purchase software, 10 million relates to internally developed software. Okay, what is this? Internally developed software. It's an in-house software, right? And whether they can capitalize them or not, it depends on the requirement in IAS 38, intangible assets. Have this internally developed software has incurred development costs, and whether those development costs are actually able to meet the condition, for the recognition. Okay, according to management, so let me put it down here. We have about 4 audit risks for the moment. The next one is about intangible assets. Okay, intangible assets. which I afraid that the 10 million is overcapitalized when the internally developed software may not be able to function as what management has expected. So why am I wearing this? This is my new mic. Hopefully the sound is better, with my new mic. Okay, for audit risk. Moving forward. According to management, the implementation of this software has already led to significant increases in sales of digital publications, and while this accounts for only approximately 20% of group revenue currently, management is confident that sales of digital publications will quickly grow. Within 3 years, is expected to overtake sales of hard copy publications across all operating segments. Using this justification, management does not consider it necessary to perform impairment reviews on any of the 3 operating segments this year. So how can I score professional marks? So I must challenge the information, right, for skeptical professional marks. So what management told me is they don't have to do impairment. So in terms of impairment, I will add on one point. The CGU, cash generating unit for impairment assessment, is separated. They are independent. I cannot say one CGU is good in performance, then the other CGU no need to do impairment. There is no such thing. So they are independent for the CGU. That's why it's inappropriate for the management to say so. Okay, comes to assessment of the impairment, the CGUs are independent to each other. Okay, in terms of operating segment, there's also one thing we can highlight. That's for the digital publications. Okay, digital publications up to 20% of the group's revenue. Then why the operating segment no such disclosures for the digital publications? So that will be another point for both technical and professional marks. Okay, the 20% digital publications is also one of the disclosure item in operating segment. Okay, so later we will tell more about operating segment, those accounting standards. All right, now exhibit 3. Okay, newspapers and magazines publication rights. A substantial portion of the group's newspaper and magazine publications are protected by publication rights, which protect the group's exclusive rights to publish the relevant newspaper or magazine for specified periods. The group owns more than 200 publication rights, which range in period of exclusivity from 5 years to 30 years. Yeah, examiner a bit funny one. 5 they put the words, but 30 they put numbers. So must read carefully. Okay, the publication rights are recognized as an intangible asset with a carrying amount of 7.9 million. Then what comes to your mind? To get professional marks, materiality level that you can calculate. It is the accounting policy to amortize the publication rights over an average of 25 years. Yes, you can treat them as intangible assets. No problem. Examiners tells you the clue. Intangible assets, no problem. Amortize is correct, but 25 years seems a little too long. The publication writes from 5 to 30 years. So some of the rights maybe last for 10 years only, maybe last for 15 years only, but they all put it in 25 years. Maybe the amortization has been prolonged. And when amortization is prolonged, you have less expense. When you have less amortized expense, then you have higher profits. So the profits could have been overstated. So our point over here, okay, for the intangible assets, one is about the software. Okay, another intangible assets is about the rights, okay, the amortization things. So we have found out 5 audit risks for the moment. How many do we need? Okay, we will see it later. Books royalty advances. The group commissions authors to write books for which the group owns the copyright. When the book is commissioned, the author is paid a royalty advance, the amount of which depends on the expected sales of the books. The group accounting policy is to defer the cost of the royalty advance within current assets until the book is published, at which the point the cost begins to be recognized as an expense, spread over 10 years period. The group finance director does not have a justification for this 10 years period other than it being industry practice. The total royalty advance projected to be recognized within the current assets is 3.4 million. Okay, so far the big amount is 7.9 million. 3.4 million must rank below, yeah, for the priority of the audit risk. So what is the audit risk over here? I'll say that matching concept is correct. You only sell the books, then only you recognize the royalty fee that you want to pay the authors as an expense. It is correct to do it in that way. You have a matching concept. You don't charge out the royalty fee first before you sell the books, but the royalty fee will be amortized with 10 years period. Yeah. So is it a little too long? When it is too long, right, the profits might have been overstated. Yeah, I don't foresee the books will be available for sale in the market for 10 years period. Yeah, usually for the first 3 to 5 years probably has finished. Yeah, the group, the owner, no need to pay for the royalty fee anymore. So 10 years is a little bit too long. Yeah, that is also one of the problem, okay, to do with the royalty fee. Okay, so we have royalty. Now, another audit risk, Borzoi's Core, is located in far land, a country which has recently experienced political unrest, leading to significant volatility in the local currency, the ACCA. At today's date, the management accounts recognize total assets of 68 million and the exchange rate is 4 to 1. In the last 6 months, the exchange rate has fluctuated between 10 to 3. Yeah, 10 to $1, 3 to $1. So it's very big fluctuations. Okay, and obviously this is an audit risk to do with the foreign exchange. Okay, so I will put it down here in the audit risk, foreign exchange. That the closing rate may not be retranslated at the closing rate, and then the income and expense item might not be translated at the actual rate or the average rate. Of course, in this case, they can't use the actual rate, the average rate, because the fluctuation has been too significant. For land requires the use of IFRS. Therefore, Borzoi prepares financial statement using IFRS. That's good. To help with the company's development of language translation operations. Okay, actually there are one more thing is hidden over here that you can score professional marks as well. They tell you Borzoi Core use IFRS standards, but the company has how many subsidiary? I remember got 20 subsidiary. Okay, if you look back to the previous page in Exhibit 2, the group has 20 subsidiaries. Is it possible that some of the other subsidiaries are not using IFRS? So that is about professional marks. Okay, so go back to the audit risk. Some subsidies not using IFRS. So if that is the case, upon consolidation, you will need to convert the accounting policies adopted by the other subsidiaries into IFRS, which is very complex. Therefore, it gives rise to the inherent risk. Yeah, inherent risk. When things are complex, comes with inherent risk. Okay. To help with the company's development of language translation operations, on 1st of May year 2017, the parent company of the group transferred a piece of translation software to Borzoi Core. The software had been purchased by the parent company for 1.5 million several years ago, and prior to transfer to the company, it was held at a carrying amount of $1 million. This being its cost less amortized to date, immediately prior to being transferred, the software was revalued in the parent company's financial statements to 5.4 million. This being its estimated fair value at the time of the transfer, the estimate of fair value was determined by group management, and this amount is still outstanding for payment by Borzoi Core. Yeah, it's kind of weird, yeah, that they go and do a revaluation. Probably is because that this company is a listed company. Maybe they want to show higher asset value and higher equity, because when they do the revaluation, the equity will goes up. Yeah, and as an auditor, we are not sure, okay, whether the 5.4 million is appropriate or not, because it is estimated by the management themselves. So the audit risk is, okay, comes to the fair value. Are they appropriate at 5.4 million or not? Even the fair value is appropriate, should they recognize the fair value? Because this is just between holding company and subsidiary company. Yeah. Should it be recognized? Okay, probably it's not. It is because it is between holding and subsidiary, and the amount still remain unpaid. And this is the transaction between holding and subsidiary. There will be inter-group transactions. Okay, in the consolidation accounts, the intergroup transaction or intra-group balances should be eliminated. Communication from Gray & Co., the previous group auditor, states the following in their communication to the audit firm. We have acted as group auditor for the last 4 years, and our opinions has been unmodified each year. However, we would like to bring to your attention a matter relating to the group's corporate governance arrangement. We found that on several occasions in the last year, the group CFO initially brought our firm access to the group audit committee, making it difficult for us to discuss matters relating to the audit with the audit committee. Yes, it is part of the requirement for auditor to communicate with audit committee in order to obtain information. But this is the problem, and sounds like corporate governance arrangement is not good enough. Okay, if that is the case, you can mention about control risk. Yeah, control risk, that the management seems a bit more secretive, that they might prevent auditor to access the information. And moreover, right, you also have inherent risk. Looking into this company, they are actually a listed entity, and maybe because of that, the management might be under pressure to perform. That's why they did a lot of things to show higher assets value, such as the intangible assets. Okay, they want to defer the amortization. Yeah, royalty also defer the expense. Then purposely revalue at 5.4 million to show higher assets value. So all these are potential inherent risks because of the management bias. Okay. So once you have done reading the questions, so over here we have about 13 audit risks. Yeah, 13 audit risks. And the marks allocation is about 18 marks. So you don't have to write all. Yeah, you just need to write 9 of them will do. 9 of them. Okay, just 9 of them for your exam purpose. So now I want you to rearrange which one sounds the most important among the others. Which one is the most important one? Because we need to prioritize them. Impairment, how much is the amount again for the impairment? Okay, they didn't mention, right? Impairment. Okay, I think the software actually worth more. The software worth more, about 10 million. Oh, sorry, 5 million for the software, 10 million for internally developed software. So probably looking into the amount, the most material one is the software. Yeah, so I'm going to write this one first. Then moving on is the 7.5 million for the publication rights. Then royalty. After that, impairment. Okay, impairment that means you can talk about. Then operating segment disclosure is also material. Yeah, fair value of 5.4 million. 5.4 million sounds better than royalty, right? So we put this one as number 3. Royalty become less important now. Oops. Okay. Wow. Too bad. Okay. Royalty become point number 6. Alright, that is enough. That is enough. You just arrange for the first 6 point, 5 to 6 point. That is already enough. So at least we start writing for the first one. Remember the concept. One package answer include 4 things: fact, accounting standards, potential restatements, and impact on the financial statements. Right? So always follow the exam techniques. Our first point is intangible assets in terms of the software. So 1 and 2, we write them together. 18 marks with 9 marks requirement. Okay, software. So regarding the software, 5 million used to purchase the software, total of 15 million. What is the total assets value? Since they are giving you the assets figure, then you have to use assets value to calculate the materiality. Total assets based on the projected figure is 95 million. Yeah, over here 95 million. The cost of software, both purchase and internally generated software, amounting to 15 million, representing 15 divided by 95 is 15.8% of total assets. Therefore, the amount is material to the statement of financial position. So you can put a bracket SOFP. So we can make use of short form later on. Yeah. So this is the first part to score the professional marks. Now, The internally, okay, keep it as short as possible. The facts from the case is the internally developed software needs to fulfill certain criteria in order to be capitalized as intangible assets. Okay. Now, you can say accounting standards, or you can just put the accounting standards number. It's up to you. But the keywords is important. IS 38, okay, states that only the development costs that meet with criteria can be capitalized, or else should be recognized as research expense in profit or loss. So this is the accounting standards. What is the potential misstatements? Some costs incurred for developing the software could be research in nature. They should be expense of, but incorrectly capitalized as intangible assets. And because of that, what are the impact on the financial statements? The development cost could be overstated because they have capitalized too much of the intangible assets and understate the research cost. Okay, so this is the package answer. And also you can talk about the amortization. Because of their capitalized development cost is wrong, it also affect the amortization. Yeah, it may be affecting the amortization expense for development costs, overstating amortization expense because they are higher development costs. So look at the answer. This is 2 marks requirement. This is another half marks requirement. 2 marks requirement. Short and precise. Okay. Only tell the things that is required to score marks. And the question also asks you, why is it auditors need to exercise high degree of professional skepticism? Every audit risk that we discuss over here, we must tell about the professional skepticism based on the question's requirement. So why do you think that management wants to capitalize more development costs? It is because management might be pressured to show higher performance, better performance. They want to show higher profits, so they capitalize all the expenses, which is not allowed one. Yeah. So auditor maintain high degree of professional skepticism in testing development costs of asset group, because this could be an indication that the group management intend to capitalize more research costs to overstate okay, the profits in showing better performance. Okay, so this is a matter why auditors want to show higher degree of professional skepticism. So can I do something to show you where I can score the professional marks? So I highlight them in yellow for those parts that I can score professional marks. Yeah, make sure you know where to pick up the 10 point. Okay, so all the highlighted in yellow one, they are professional marks. So for the moment, we only have one. Okay, let's take a break. Yeah, let's take a break. Come back, we will continue to know how to write the other audit risk. Then part B of the questions. Yeah, then we move forward to the analytical procedures. So if can, we try to finish the analytical procedures in the next question as well for today's lessons. So let's take a break. We come back around 8:15. Yeah, 8:15. If you have any question, can leave it in the chat box. Sorry to include the subtitle just now. Subheadings just now. Okay, just include it. Intangible assets internally generated. Good view. So sounds like a next paragraph. Okay, so we are going to write down the second one. We have intangible assets on the publication rights. So what is about publication rights? 7.9 million for the publication rights. The publication rights recognized as intangible assets at 7.9 million, representing 8.3% of total assets, which is material to the statement of financial position. So this is the professional marks. Excuse me. So keep it short. The average amortization rate is based on 25 years, where the definite useful life of these rights ranging from 5 years to 30 years. Some publication rights are probably having shorter definite useful life at 25 years. So what is the effect on the financial statements? This is the potential misstatement, and so leading to understatement of amortization expense over statement of profit and intangible assets. So how much is the understatement? I don't know. I must go through the details, then only I know about it. Okay, how much how many useful life for the respective publication rights. So simply based on industrial practice, is it relates to this case? No, industrial practice is the royalty advance, so that one later. Okay, now this one is the answer over here. Yeah, that's it. Just keep it as short as possible and tell the effect on the financial statements. Now, why is it auditors will need to remain professional skeptical on this part? Okay, again, it could be a practice that management tends to overstate the profit by manipulating the definite useful life of publication rights. Auditor must maintain high degree of professional skepticism in challenging management assumptions, because we need to challenge the management assumptions on the use of 25 years amortization periods. Okay, whether it is reasonable. Yeah, whether it is reasonable. Okay, that's for part 2, the 9 marks requirement. The third point is about the fair value at 5.4 million. Okay, they have something with the language translation operation. It's a translation software. Okay, just a subheading, translation software, revaluation. A revaluation has been performed for a translation software immediately before transfer to its subsidiary Bozoico at the fair value of 5.4 million. So the carrying amount of this software, yeah, the carrying amount is 1 million, right? The carrying amount at 1 million. So there will be a revaluation surplus at 4.4 million. If this amount is inappropriate, the misstatement will be 4.4 million, yeah, which is equivalent to 4.4 million divided by 95 million of the total assets is 4.6% of group total assets, which is material to the. Okay, let me read the questions again. I think I make some mistakes. This is the group in total, so I made some mistake. I should put consolidated statement of financial position. Can you change for me? Over here, the first paragraph, put consolidated statement of financial position. Yeah, add on this word, consolidated statement of financial position which is CSFOP. Yeah, CSOFP, Consolidated Financial Position. And all the answers just now can make some changes. C, Statement of Financial Position. Same thing to here, Consolidated Statement of Financial Position. Okay, another professional marks we gain from here. So I think it's enough for the materiality level by now, as we have done with 3 points. Yeah, about 3 points. So you want to do revaluation of the intangible assets with this software. It is okay on the condition that there is the open market. There is a demand, yeah, for this software in the markets, and they are actually transfer at the arm's length basis. Yeah, they are actually having this fair value. Okay, so it is permitted to revalue the software to a higher fair value, provided that the software is having an open market and the market is in demand of the software. If the markets, there is no active market, yeah, then it is very unusual to revalue a software. If there is no active market, then it seems inappropriate to inflate the value of the software. So what is the accounting standards that we are talking about over here? It is about IAS 38. Yeah, do you revalue the software or not? Okay, so in this case, right, they have revalued it and probably has recognized the equity. Yeah, so in this case, right, equity for the revaluation could have been overstated if the fair value is inappropriate. Now, not just talking about accounting standards, on the other hand, there is also an inherent risk, because one of the inherent risk factors is uncertainty. Okay, is uncertainty. Like based on judgment. It also highlighted an inherent risk that the fair value itself is subjective in nature, involve management judgment in making the, because in the scenario they mentioned that it is a group management to come up with the fair value. So it involves management judgment in making the fair value. Therefore, the fair value at 5.4 million could be overstated. Yeah, and why auditors will need to maintain high degree of professional skepticism in this case? Auditor needs to maintain high professional skepticism is because the amount come from the management which is not reliable. Yeah, because the fair value was determined by management which is less reliable. Yeah, and also it could be an intention for management to overstate the assets yeah, the receivable balance, because they have disposed it to Bourgeois call, overstates the receivable balance owing from a subsidiary at company level. I'm not talking about group level. At company level, they might have overstated the receivable balance, purposely doing so in order to show good financial position of the parent company. Yeah, as a implication of the transaction as well. Yeah, there will be intra-group balances for the receivable should be eliminated, but that one I will talk about it later. The 5.4 million should be shown in the receivable balance, but because the amount was due from the subsidiary, they should be taken away. Yeah, they should be taken away. So this is about the translation software. You can also talk about the subsequent amortization could have been affected. Okay, so what is the next point again? Point number 4 is about impairment. Yeah, point number 4 is impairment over here. So impairment on the CGU, yeah, cash generating unit. Okay, impairment. Okay, let's read the scenario for quick one. They mention something about operating segment where the management does not consider it necessary to perform impairment reviews on any of the 3 operating segments this year. Okay. The management is not performing an impairment review on the operating segment this year, relying on the fact that one operating segment is going to be outperformed. Okay, so this sentence itself can score professional marks because we are making use of the scenario and we remain skeptical on that. Okay, it is inappropriate not to conduct impairment review on these operating segments as the cash generating units with each segment. Okay, each of the segments here as one of the CGU is independent for the purpose of impairment review. Okay. Some more in these questions over here, you can see that the revenue has dropped, which is an indication that this operating segment should be subject to impairment review. Okay, look at the scenario here. Newspaper, the revenue has dropped. Academic journals, revenue increase. Books, drop from 45 million to 42 million. Okay. Okay, as seen in the, now I'm telling the package answer right now, yeah, the 2 marks package answer, as seen in the scenario. Newspaper and magazine, books segments are showing drop in revenue, which is an indication for impairment. So that is the fact from the case. Again, this one also helps you to score professional marks as we will make use of the scenario. So this is the fact. Now, what is the next thing? You talk about accounting standards. Yeah, impairment. Okay, this one from the notes. Yeah, you can get it from here. Okay, so IAS 36. Yeah, for the impairment. I will just talk about the accounting standards. Impairment is required when the carrying amount is more than the recoverable amount, where the recoverable amount is the higher of fair value less cost to sell or value in use. Okay, so this is the accounting standards. If there is impairment for this operating segment and management did not perform impairment, the profits will be overstated. Okay, that is the impact on the financial statements. So we just finished the package answer. 2 marks requirement starting from here. Okay, so any other things that you can tell? So speaking of impairment, this group has 20 subsidiaries. Okay, the group has 20 subsidiaries. Okay, this is my assumption. There could be some goodwill requires impairment test regardless whether having an indication or not, right? Goodwill must be subject to impairment test whether got indication or not. And the management didn't say, management did say they don't have to perform impairment review, which is not correct following the accounting standards, right? Some impairment may not be recognized. So, what am I trying to score over here? Professional marks, right? Some impairment may not be recognized. This is analysis and evaluation. Yeah, analysis and evaluation. From the scenario, we evaluate in such a way. Okay. Now the next point, after point number 4, actually we score more than 2 marks for each point for the moment. Point number 5 is operating segment. Okay. Operating segment. Okay. Operating segment is about disclosure. For all the listed entity, they need it. Okay. They need to disclose their operating segment. And let's write down the package answer first. Yeah. What is the package answer over here? The management has selected operating segments for disclosures, but not include digital. There's one thing called digital publications over here. Yeah, digital publications include digital publications, which amounts to 20% of the group revenue. Okay, so this is the facts from the case. What is the accounting standards? Okay, IFRS 8 No need to remember the accounting standards number. It's okay. You can just say financial reporting framework requires the operating segment, okay, to be disclosed when, okay. So interested to know what accounting standard has mentioned, you can find out from this part over here. IFRS 8, what is operating segment? It has been regularly reviewed by the chief operating decision maker. You see, operating segment is a component that engage in the business activity that can generate revenue and expense on its own, and regularly reviewed by chief operating decision maker for them to make decision whether how much resources they want to allocate. So it is a reportable segment under IFRS 8 when the threshold has exceeded 10% of the revenue. Okay, 10% of profit before tax or 10% of assets value. So it's always use 10% of the benchmark. Yeah. So it requires operating segment to be disclosed when the reportable, just tell some keywords from the accounting standards. The reportable segments achieve the threshold of 10% of certain benchmark, and the component can generate revenues and incur costs on its own, where chief operating decision makers will regularly review the performance to decide how much resources to be allocated. So we tell something for the accounting standards. Yeah, a bit long for the answer, but you can score better marks. Alright, now the digital publications has reached the threshold and should be included as disclosure for operating segment. There will be a misstatement if this operating segment is not disclosed. Okay, why auditors wants to maintain, okay, this is the full package answer, yeah, 2 marks requirement. More than 2 marks over here because slightly longer for the accounting standards explanation. Why this requires high professional skepticism, high degree of professional skepticism? It is because the management choice of the operating segment might tend to exclude certain segments that are not performing well. Yeah, management bias. Okay, auditor needs to maintain high professional skepticism to evaluate how the management choose the operating segments to be disclosed, as management may tends to avoid disclosure on certain poor perform operating segment. Okay, and also the hidden operating segment from the management. Okay, so this is another point. Yeah, this is another point. Point number 5 is done. Okay, operating segment is done. Point number 6 is about the royalty fee. Yeah, the royalty fee. So the books companies will commission the authors in advance up to 3.4 million in the current assets. So no need to comment on the maturity level anymore, as we have done about 3 points since just now. So we can save some time. Okay, the problem is spread over 10 years period for the current assets. So they make the payment, but they remain them as current assets, slowly released to the statement of profit or loss for the expense over 10 years time. Okay, royalty fee. Okay, so facts from the case is assets group treats the advance payment to authors as current assets and amortize to profit or loss over 10 years period. It is appropriate to match the royalty expense to sales of book. When they sell it, then only they charge out as an expense. It is appropriate to have the matching. Now, this one will be helping you to score professional marks because you make use of the case, analysis and evaluation. Okay, you tell something that you know about matching concept. Then, however, the amortization period for 10 years seems too long. Current assets could be overstated and royalty expense would be understated. Of course, you also can say that profit is overstated. Because expense is understated, profit will be overstated. So this is the point for accounting issues. What is the audit risk over here? And then, why auditors need to maintain high professional skepticism on this part? The management just mentioned 10 years is the industrial practice. Now, auditors needs to maintain professional skepticism to challenge the management assumptions with 10 years amortization period. Obtain a justifiable explanation rather than simply accept the assumptions of 10 years with industrial practice. Yeah, so auditors shouldn't accept on that. Yeah, must challenge the client in terms of the royalty fees. Why they based on 10 years? Yeah, auditor we need to assess the reasonableness of the time period. Okay. For the royalty fee, whether we should explain in intangible assets. Now, intangible assets, This is just simply the prepayment. You know, the books, the company is having the copyrights and they will need to pay royalty fee. So let's say I am the company, I pay royalty fee for the authors to write the books. When I pay them, I should charge out as an expense. By right, it should be that way. No assets. Credit bank, debit royalty fee as the expense. Then the company say, I want to charge out only when I sell the books. Okay, that also can. Yeah, you also can do that. By the time when you sell the book, then only you charge out the expense. The problem is they go and put this slowly charge as expense with the period of 10 years time. So it's a bit too slow for them to release the assets to the expense. This is just a simple prepayment. It's just a prepayment that they slowly charge out as an expense. So they purposely prolong the period. Maybe they want to show higher profits. Yeah, you also can mention that for the professional skepticism. Okay, no need for the intangible assets because intangible assets is non-current assets. That one has to do with licensing fee or development cost. This is just an expense, the normal one. So the remaining point, okay, you can arrange, see which one you prefer to write. Yeah, now which one is more significant? I think intra-group transaction is more significant. Okay, that is everything I group in consolidation. Consolidation. Okay, so just now we have highlighted about the intra-group transactions. Okay, the intra-group transactions should be eliminated from the consolidated financial statements of Bassett's Group. Including the 5.4 million receivable balance from Borzoi Core. So just one sentence would do. And then they also mentioned that Borzoi Core is using IFRS. Just now we come across with the point that about this. How about the other 20 subsidiaries? The other 20 subsidiaries, sorry, no need to say the others, just say there's 20 subsidiaries excluding Borzoi. Some could be using local accounting framework to prepare the financial statements. Okay, upon consolidation, the accounting policies, okay, this is about the accounting standards, some standard wordings. So I just want to score some marks over here. Upon consolidation, the accounting policies adopted by the parent company should be applied to all the subsidiaries. Okay. The difficult part is the conversion. The conversion of the accounting policies could be complex and leading to high inherent risk. When things are complex, we have inherent risk. So you mentioned that this is inherent risk. Not easy to convert, in fact. Yeah. So this is something about the consolidation that we can mention. Okay. So what else you want to tell? From the scenario, they also mention about this is a new client, right? New client. New client itself is a point. Okay, as Bassett's group is a new client. Auditor, okay, very standardized answer. We say auditor has lack of understanding about the background of the company and the accounting policies, leading to higher detection risk.